The U.S. economy is surging, and President Trump just secured a sweeping trade deal with the European Union. But with the Fed holding interest rates steady, what's next for growth, inflation, and global markets? I'm Veronica Dudo. Let's find out.
This is In America Today from the Ticker News Studios in New York City.
The U.S. economy surprised many analysts by growing at a 3% annual rate last quarter, bouncing back from earlier turbulence tied to ongoing trade disputes. President Donald Trump has now announced a major breakthrough, a new framework for a trade deal between the U.S. and the European Union. The agreement sets a uniform 15% tariff on goods, including autos, and opens up European markets previously seen as closed to American exports. This economic upswing comes as the Federal Reserve defies pressure from the White House by holding interest rates steady. Here's President Trump discussing his administration's recent trade deals and its impact on the U.S. economy.
Well, we have reduced the federal workforce by 70,000 jobs. So these are private jobs that are coming back to our country. Federal jobs are being cut. Critics said that our tariffs would hurt the economy, but the data shows the exact opposite, and the exact opposite is happening. The U.S. Treasury has taken in $150 billion from tariffs, and we'll be adding about $200 billion next month for totals that nobody's ever seen before, frankly. And foreign imports were down 30% in the second quarter, while the domestic auto production surged by a stunning 36%. How about that number, Dr. Oz? Right, that's good. That's good. We want to do that with your patients too. We'll have a very healthy. We're going to have a very healthy country. At the same time, inflation continues to fall faster than expectations.
For more, I'm joined by Jake Clompton, an economist and the president of Clompton Capital. Welcome to the show.
Thanks so much. Thanks for having me on.
So first, let's begin with what does the 3% growth in Q2 tell us about the underlying strength of the U.S. economy right now?
It's a good question. So that the GDP reports, are definitely, there's a lot of noise going on in those. A lot of the GDP drawdown we saw earlier this year was because there were so many imports that were coming in. I think people were getting ahead of tariffs and building inventory and stuff like that. And we actually really kind of saw the opposite effect in this more recent GDP report. So you saw a lot of the upside numbers because imports were so low. The economy's still strong. There is kind of a backdrop to a little bit of slowing going on. But I think if you dig into the report, start looking at the import numbers, you see a lot of, what was going on was because of lower imports. But again, the economy's still strong, a little bit of slowing going on in different sectors.
Now, we heard the president there speaking, talking about a lot of money that will be coming into the United States from these trade deals, from the tariffs. Do we know yet where that will be used or how, and what impact could that have on the economy for potentially Wall Street and also Main Street?
Great question. I think, whenever there's additional money coming in and going into the supply, it's going to be good for the economy. And there is this whole concept of fiscal dominance going on. There's so much government spending going on. It's really going to prop up the economy. And now they're talking about stuff like stimulus checks for, offsetting tariffs and things like that. So, if you look at M2 money supply, for instance, you are seeing like a tick up in M2 money supply, out there in the system. So anytime you see that, I think you're going to see, money expansion, and the economy is going to generally do well. The drawdown of that is that does put in pressure on inflation. So it could keep those inflationary numbers up, and that is probably something to watch going forward. But anytime we're getting, the government's getting more revenue coming in, they're going to spend that, and it's going to go into the economy.
Now, of course, the summer is moving along, and we know there are a lot of deadlines in August. But first, let's talk about how significant is the new U.S.-EU trade agreement in terms of market access and stability?
I think there still remains to be seen, like how much they actually stick to in that agreement. And it's the same thing with all these trade agreements, right? I mean, it's great on paper, but you got to see like what actually comes to fruition. The biggest difference is we were starting from this point of basically there was no downside to us negotiating, right? Because all these countries had been taking advantage of the U.S. for so long. So, the investment that they've guaranteed, and they said they're going to buy like all this natural gas and various stuff from the U.S. There's really just a lot of upside there. So I think, moving forward, the U.S. is going to be in a much better position. And, these countries that have really, had unfair trade policies before, kind of blocked U.S. businesses, we're going to get a lot more opportunity because of those.
Will the 15% uniform tariff help or hurt American consumers and manufacturers in the long term?
I think that's a good question. I think that remains to be seen. Like right now, what we're seeing is really not seeing a lot of the tariff costs pass on to consumers. I think right now, like a lot of manufacturers are eating a lot of that cost. Eventually, I'm sure those costs are going to be passed on to the consumer as they can. It always kind of does. The consumer is kind of feeling a little tapped up right now with price increases. We are starting to see some cracks, in various places like, increases in credit card defaults and stuff like that. So I think the ability for some of these manufacturers and resellers to really pass that on to consumers is tough right now. Eventually they will be. But overall, I think it's definitely a positive for the economy, for our companies to have more price competitiveness in the international market and at home domestically. And then, the increased revenue that the government's going to get, all of that's going to filter back in through the economy. And again, I think it's a net positive, but eventually I think consumers probably do see an increase in prices.
So we heard from Federal Reserve Chair Jerome Powell again saying that he will hold the rates steady. Why is the Federal Reserve resisting President Trump's push for interest rate cuts despite strong economic numbers?
Right. So I know there's a huge debate about, the Fed lowering rates. And you really just cut through the noise and kind of ignore all the headlines that are out there and look at their dual mandate, right? I mean, it's labor force, stability and to keep inflation under control. And right now, if you look at just the data that's out there, look at the core PCE number that came out and the adjustments that came out, just recently. Inflation is still running hot. It's still running above their 2% target. So really no reason to lower rates there if you're looking at the inflation side of things. And then look at the labor market, right? The labor market's still very strong. There are indications, right, that things are moving in the right direction for a rate cut. Inflation is coming down. We are starting to see, like initial jobless claims are starting to jump, and there's like some small cracks showing in the economy and the labor market, but it's still strong, and there's still very strong employment out there. And until one of these factors kind of overtakes the other, you're not really gonna get any movement in interest rates. So until you really see a lot of risk in the labor market, they can't really ignore the fact that inflation is still above their target, and they're going to keep rates where they are. I don't think there's a September rate, cut, on the horizon unless some data comes out in the next couple of weeks that really points to either labor, taking a hit or inflation coming down significantly. But it may still be too soon to even do a September rate cut at that point.
What impact might the Fed's current stance have on markets, lending, and consumer confidence?
I think as far as their current stance, they're just holding steady, right? People would love for rates to come down, for the cost of capital to come down. But I can tell you in our markets, right? And I'm in commercial real estate, lending for the most part. People are starting to adjust to the higher cost of capital, right? I mean, at first, I think people were really expecting rates to come down significantly and kind of holding off. And that's what I've seen a lot of, like people like waiting for rates to come down. But I think a lot of people and businesses have kind of given up on that and, saying, hey, we need to move on. We need to readjust. And when you're on the commercial and the business side of the cost of capital discussion, it's a math problem, right? And, once, people have gotten used to and accepted the fact that rates aren't going to be coming down significantly this year, you readjust those parts of the math problem to make whatever you're working on work for the current rate environment. So, I am seeing a lot of unthawing of deals that people thought they were going to put on hold to when rates came down, and they're kind of moving forward. As far as the consumer, it's probably the same, same position. The areas where it does get really hard is, housing, because not only do you have a high cost of capital there, but you have very low affordability, other parts of, purchasing a home. There's the home prices continue to rise despite, low buyer demand at these prices. So that it's really an interesting concept. And you have like huge supply that's on the market. And a lot of this is just because not only is the cost of capital for mortgages very high, but there's a lot of other aspects to housing that, input costs of like repairs and all this, and consumer not having a lot of disposable income that are making housing very unaffordable. So eventually, when it comes to housing, one of those factors has to move. My guess is it's probably home prices first before you see a lot of lower cost of capital. But I don't know. We're going to wait and see what happens. But there's definitely still a lot of hesitancy and a lot of pause in the housing market that's out there.
Jake Clompton from Clompton Capital, thank you so much for your time today.
Thank you so much.
This is Ticker. We'll be right back.